So today I'm going to be joined by Mr. Christopher Freeman. Chris is a seasoned property investor and has been doing property development for over 30 years. He's run 5 real estate offices in his time. I'm Dr. Matthew Bateman. I'm a chiropractor who has successfully transitioned from owning businesses into becoming a full-time property investor myself. I'm also doing a number of developments at the moment. One is a 60-lot subdivision over in Western Australia. So Chris and I are going to share quite a bit with you today. The goal of today is obviously to teach you a new strategy and get you guys really, I guess, focused on your future and what you can do to get a better result for your life. So today we're going to cover a fair bit. So it's going to take us about 60 minutes or so to run through all of these 11 points. So the first thing we're going to cover is obviously how people buy property today, particularly those that are what we would consider to be an average buyer versus those that have a little bit more knowledge, a little bit more skill set, and have the ability to get better results for themselves. We're going to look at the market drivers, look at what actually drives property pricing. We're going to look at things like supply and demand. We're going to introduce you to the concept of land banking. Who does it? Why would you choose land in the first place? Why not to choose land? We're going to look at things like the urban growth boundary, the 2050 plan for Melbourne, and how that has actually shaped and impacted our due diligence. We're going to look at some rewards, and we're also going to look at some risks. And we're going to give you an opportunity at the end of this to really have some time with a senior property consultant to work out whether this strategy is right for you or not. Okay, so just quickly getting all the disclaimers out of the way. Obviously, we'll take every care to make sure that this information is accurate. But obviously this is not financial advice. What we want to do here is give you some general information to help you start to make better decisions for yourself and your family. At the end of this presentation, we will give you the opportunity to actually speak with a qualified professional before we go any further. Okay, so here we go. Average buyer or advanced investor. Okay, so we'll see that 90% of people who actually invest in property generally do what most people do. I call them accidental investors, and that is they go out and they've got the great Australian dream to buy a property. Okay, now they're buying it not necessarily as an investment decision, they're buying it for emotional reasons. They like the area, they need somewhere to live, their family has always probably told them, you know, you buy a property and you pay it off over 30 years and everything will be okay. Now I'm going to speak with Chris later. Chris and I both get to work with some people who tried that strategy and who unfortunately may or may not have had the right result in the long term. Then there's a small percentage of investors, approximately 10% here, which we'd call advanced investors. Now people have more knowledge about property and how property works. That can include things like off the plan, it can include things like subdivision and development, it can include things like land banking, which we're going to discuss today. And then obviously if you get very, very good at property and you want to take it to a whole new level, you can become one of those big players in property. And we're going to share some of the things that they've been doing over the years. Now, in addition to this, what we're going to do is obviously just quickly look at how do you buy property without loans? Because most people, if you're going to buy a property, the normal property by an average buyer, you're going to go out and you're going to pay a deposit. Now, normally that deposit's going to be in the range of 10 or 20% of the purchase price. You're then going to have to come up with additional funds for stamp duties. You also then have to go out and take out a loan. So there's debt capacity or serviceability. We then have to worry about cash flow, meaning is the amount of income that we're receiving more or less than the expenses that we have on that property. And obviously to secure and find good deals takes time and research. So what we want to do is show you how to, I guess, move away from being an average buyer and how to actually move into the world of more advanced investing. Now let's look at what are some of the typical features of an average buyer. Number one, they procrastinate and they do nothing. Now, most average buyers will, when given information, will and ah, change their mind 10 times or 20 times, and then eventually decide that it's all too risky and they're not going to do anything at all. Whereas advanced investors, when they've learned what they want to do, they learn how to do it, they're going to be much faster with their decision-making processes, and when they make a decision, they're going to stick to it. Emotional decisions for average buyers, and again, it's usually something to do with, you know, the color of the house or, you know, where it's near, whereas with an advanced investor, we're really not making emotional decisions about property. We're actually making commercial decisions, and that is it going to make us money in the short, medium, and longer term? most average buyers just go on gut feel, whereas advanced investors are going to use tools, data, due diligence, and research to get the results. Now, average buyers believe everything that an agent will tell them, whereas an advanced investor will actually look beyond sales and hype and actually go in at deeper levels to get objective information. The average buyer wants to own the property, whereas advanced investors want to control property. And there's a big difference, and we're going to talk about controlling property later in this presentation. The average buyer tries to do everything themselves, whereas advanced investors really leverage off the skills of a team that they create over time, and we call it an A-team, okay, the best in the business. Average buyers tend to focus on finance and money, and they tend to be cost-focused, whereas advanced investors really are value-focused. And I'm going to give you a couple of examples of value focus later on down the track as opposed to cost focus. Okay, the average buyer, when they buy a property, are obviously hoping for that property to go up in value. Whereas an advanced investor, sure, they'll take advantage of capital growth, but they're also going to know what their profits are up front. They want to lock in value and they want to lock in profit and make money on the way into the deal. Average buyers tend to be return on asset focused, whereas advanced investors tend to be return on investment focus. And there is a big difference, which I will discuss with you as we come up with some examples in the land banking later on. And obviously an average buyer will generally be paying retail price, whereas advanced investors or our members will generally try to buy property at a discount or with some unique feature that's going to help them to outperform the market in the short, the medium, and the longer term. So let's look at the property clock, and I might pass this time now over to Chris, and I'm going to get Chris to just have a quick chat to us about the property clock and what it actually represents.
Well, welcome everybody. It's Chris Freeman. I've recognised a few of the names that are booked in tonight, so welcome to all of you. As you know, for the people that don't know, I started subdividing and developing land 30 years ago. So I guess tonight I'm here to really endorse the land banking strategy. It's amazing. I think it's a revolution in the way property investing is going. It's the future of property investing, putting down a very small amount of money, controlling a valuable piece of land and not having to settle on that for 7 to 10 years. And particularly in Melbourne land banking, I mean, we've been doing this in Bendigo previously, but to put this deal together in Melbourne, particularly Southeast Bayside, where it is the fastest growing council in the Melbourne area, is just quite incredible. Now, the property clock, yeah, we are in a very interesting time. For those of you that watched the block last night, that's the area I live in, where it's $10,000 a square metre. That's just down the road from me. Those properties went for 2.6 million three-bedroom apartments, which was quite incredible. Generates a lot of interest in the property. But with all these low interest rates we're having and all the cheap money around the world, we are seeing strong growth in Melbourne and Sydney particularly. So right now we're in the rising part of the property clock there, which you can see on the screen. So it's a great time to be getting in. And look, I'm going to pass you back to Matthew, and I'll be talking more about this new land banking project later in the event.
Thanks, Chris. And you guys are very fortunate tonight, obviously not only to have myself, but to have Chris here to really explain this new process of actually being able to get land at a very, very cheap price today and not settle on it for a very long term. What I want to talk about quickly is the two primary drivers of property pricing. So first and foremost, we've got what we call consumer sentiment, and that's the mood of the day. And that can be affected by a lot of things, but it generally tends to be fairly short term. The things that tend to affect consumer sentiment can be things like events. And if we look back over last year, there was quite a few events that occurred. We had many people worried that the US would fall off the fiscal cliff, if you can remember that. Obviously, the US didn't go into default on its debts at this stage, and the economy in the US is starting to move forward. The European banking system didn't collapse like some were expecting. China has not had a hard landing despite reports of ghost cities and claims of massive debt and a property bubble in China. Australia didn't fall into a recession despite the mining or the peak of mining spending slowing down. And obviously all those people who predicted last year that our property markets would crash were just unfortunately wrong. So what actually did happen last year, we had one of the longest running election campaigns in history. We were effectively led by 3 different prime ministers, and our economy continued to grow, albeit a little bit slower than many had predicted, around 2.3% over the year. Inflation has remained very low and within the RBA's target band, and that gave the RBA the ability to cut official rates, and in fact they cut them twice last year to a historic low of just 2.5%. Now, what happened to property prices last year? Well, if you've been following any of the property statistics, we know that on average, property prices, median prices around Australia grew by around about 9.8% in our capital cities. That was strongly led by Sydney and Perth and Melbourne. So as you look at the clock here, you'll see that the clock is basically a way of looking at how property moves in a cycle. And those cycles generally are between 7 to 10 years around the clock. So if we look at where the clock is at the top at 12, that's when obviously prices are at their highest. Leading up to that happening though, we tend to go through some rising construction because at the bottom of the market, there's generally an undersupply. Construction has slowed around the 4 and 5 mark, prices bottom out, there's an undersupply, and the smart money starts to come in at around 6 o'clock. By the time we get to 7 and 8, we start to get some increased excitement, and we start to get increasing auction clearance rates. We start to get more sales volumes, and then that leads to developers going, hang on, property prices are rising, we need to get back into the market. They go out and start building, and again, there's always a delay between when developers get into the market and when the construction of those properties always occurs. And then we go through this process again. So in addition to obviously having consumer sentiment dictate where we're at any point in time, the other thing that will really drive that is actually the media. So when we have media, we can actually do another clock, which is actually to do with media. And this is really interesting for those. Some people have seen the property clock, but they may not have seen the media clock in regard to property. Same rules. The top's the peak, the 6 o'clock is the bottom. There's actually two distinct times. There's those where the media is mixed, and there's those where the media is quite either positive or quite negative. So right now, if we look at what's happening around the media in property, what we start to see is some articles like this. This was April last year. Now, we started telling our members probably a good 18 months ago that the property market was nearing a bottom, and we would be soon moving up into the next phase or the next upward swing of the property market. So we've got articles coming through the paper last year like homing on a peak, market on the rise. We've got tide starts to turn for sales. This was coming into May. So this is starting to become a real positive part of the media. July 27, we've got home boom hope. Record prices are on the way back up with Melbourne homeowners in for a great Christmas. We've then got, in July as well, housing boom tip for 2014. So we're seeing that all of these articles are generally quite positive, which is an indication that we are in an upward swinging market. I don't believe we're in any sort of frenzy at the moment. I do believe that we've got some good, consistent growth. And if we look at some property commentators, Mark Burris here from Yellow Brick Road has said that property is the hottest investment class for the next 5 years. And he said that last June. Now, obviously, when he was saying that, Sydney prices weren't doing their 12 or 14% growth. Melbourne wasn't doing its 9.5%. Perth wasn't doing its 9.5% growth. So a lot of the commentators, if they follow property and they're in property, we can actually predict ahead of time what's going to happen or what's likely to happen into the property market, particularly when we take out the short-term consumer sentiment influences on property. Burris goes on to say that from now until about 5 years' time, house prices will go up quite a lot, and it's a good time to take an opportunity to invest in real estate. This is my comment at the bottom. If you think about it, low interest rates generally reposition houses upwards, and that means upward pressure on land prices, which we're going to talk a lot about today. So when we go past consumer sentiment, which as I said tends to be short-term, tends to be driven by popular events and media, we move into what we call the market fundamentals, and these are more medium to long-term. They're far more predictable, okay, and they hold true in far greater numbers than the consumer sentiment will. So when we look at things that we're looking at in terms of population growth, let's just look at some facts. Melbourne's population, I'm going to focus, guys, mainly on Melbourne here today because our land banking opportunity is a Melbourne-based land banking opportunity. It's within the urban growth boundary. It's in one of the hottest suburbs in all of Australia. So we're really going to focus for a lot of today on Melbourne. But let's just look at the population. Last year, 2013, Melbourne's population grew by 400,000 people, or 1.8% of our population. And that's going to underpin household formation and the demand for residential property. If you actually do some of the due diligence that we do, and you've read a report such as Melbourne 2050, which is the Plan Melbourne guide to how Melbourne's actually going to move forward and deliver not just homes, but jobs, investment, how to to connect Melbourne, infrastructure and transport, how it's going to make it livable and maintain the status of Melbourne as the #1 city in the world, we need to really understand that Melbourne is predicted to be a city of over 6 million people by 2050. It's actually predicted to overtake Sydney and become once again the most populated city, capital city in Australia. What's also interesting about this population growth is that the demographic trends, and I'll talk about demographic trends in a moment, but we're actually getting a larger number in the number of Generation Ys. The growth in 30-somethings will rise from about 10,000 a year to over 100,000 a year in the future. Okay, and that's going to have a big impact on our demographic trends, on the way that people form households, what sort of property they're looking for, and where they're buying. So we're going to come back and spend a lot more time on that as well. So when we go forward and we start to look a little bit more into numbers, what we'll see is that Melbourne, once again, 3rd year in a row, has been voted the most livable city in the world. And Chris, you're an ardent fan of Melbourne. I want to ask you some questions. Tell me, why do you live in Melbourne?
Well, for all those people out there that are from Sydney, please excuse me, but I did live in Sydney for 10 years and I was driven out by the traffic and just the general chaos in Sydney. And I moved to Melbourne, and I can say that, you know, Melbourne's got the largest tram network in the world. It's a planned city. Where I live in Albert Park, it's beautiful. There's hardly any traffic. It's like living in a little country town. I also found Melbourne to be a lot more friendly and a lot more multicultural. And Melbourne's growing at a much faster rate and will overtake Sydney in the near future, I would say. Also, it has every sporting event imaginable, fashion event, food event. You know, every weekend there's something here. There's got the AFL, your Boxing Day Test match, you've got the Melbourne Cup, you've got the Grand Prix. This whole city is designed for these world international events, and it's just an amazing atmosphere. It's also got a lot of parklands right throughout it, right down, like it's a massive city, right down to Portsea, which is 110 kilometres from the CBD. This Landbanking, this Melbourne Landbanking, is in the southeast Bayside region, which is a prime growing area. Matthew mentioned before, there is a boundary now where you can't keep subdividing, and you've got the Dandenong Ranges and everything else blocking you out. So all these people are moving to Melbourne from all over the world because it is the most livable country in the world, and this is the most livable city. And yeah, $1,500 people a week. So look, if getting into Bayside Melbourne is a lot different to, say, getting into the western suburbs like Werribee and places like that. You've got the beautiful Mornington Peninsula, you've got the Frankston all being upgraded. There's just some incredible things happening down there. And this piece of land where the 300 blocks are is in the heart and soul of Bayside Melbourne. And also with the Hastings second port now going ahead, that will bring in enormous growth to this area. So let's put Matthew back on for a second now.
Thanks, Chris. Like Chris, I actually was a Sydney-sider as well. Grew up, born and bred, spent the first 30-odd years of my life in Sydney. Came down to Melbourne for a work opportunity, and I haven't quite left yet, and that was about 14 years ago. And carrying on from Chris, I absolutely concur. Melbourne has a calmer vibe to it. It's very multicultural. It's got everything that, if you're into food, which I am, or you're into sport, which I am, it's got a world of opportunities. It's got a massively stronger economy. It's robust, affordable compared to Sydney. There's a lot of things going for Melbourne. So as we look a little bit further now into the market fundamentals, we've covered population growth and why Melbourne's so popular. Obviously, when we look at market fundamentals, we do need to consider at a global level what's happening overseas as well as what's happening nationally as well as locally. I'm not going to spend a lot of time on these things today other than to say that obviously the G20 has recently met. Australia is now actually leading the structural discussion around the G20, and what we're really pushing for is a global coordination, trying to lift the output by at least 2% above previous projections over the next 5 years. And in the process, the global economy is trying to kickstart and potentially create millions of new jobs. Okay, and that's a really important thing for you guys to understand. Obviously, the G20 is made up of countries such as Australia, Brazil, Canada, China, France and Germany, Japan's in there, Russia, South Africa, the United Kingdom, and the United States, and obviously the European Union. So these are the powerhouses, the kegs, if you like, of the world economy, and they're really trying to push growth. Now, when we look at the next slide, what we'll see is that one of the things that happens around the world, and Australia is no different, but one of the things that happens in most advanced economies is that residential real estate underpins the wealth position of a nation, and in fact it's a global wealth phenomena. About 70% of all the wealth held in the world is actually held in residential properties, or properties, commercial, residential, etc. Now look at the numbers here, people. Residential real estate in Australia is a $4.86 trillion investment. In fact, it's more than that. It's actually over $5 trillion now. This was actually some old data. I think this was in 2011. So we've actually hit $5 trillion mark where residential real estate in terms of wealth. Compare that to Australian superannuation, you start to see that property is the #1 vehicle for wealth in this country. And what's something that's very, very, very important for you guys to understand is that 1 in 3 houses only has a mortgage attached to it in Australia. And that really underpins the resiliency, and it really underpins the ability for property to not drop in value over time. And there's a lot of economists out there that are saying the property market may be overheated, but they've been saying that for the last 50 years. Okay, and Australia has proven incredibly resilient. Our economy has grown from strength to strength. We've had, dozens of consecutive quarters of GDP growth. We were one of the few countries that didn't go into a recession through the GFC. Australia has an enormous amount of wealth in its mining and its people and its education, its tourism. Australia's economy, and particularly Australia's residential property market, is incredibly healthy, and I want you guys to understand that. The next thing I want you to understand is that mining, obviously in this country, the peak of the spending is slowing. Okay, so what we need to look at, and according to David Gruen, who's the Executive Director of Treasury's Macroeconomic Group, he says, in a couple of years when mining does not contribute to growth the same way it is now, we need other things to contribute to growth. I'm going to ask you guys out there, what is the most obvious thing to contribute to growth? Well, it's really our housing market. And given that we are currently in a nationwide undersupply of property, the natural and most desirable development moving forward is that we see more property activity. This comes off the back of similar comments by the RBA. If we actually look at what's happening today in land, I'll just show you at the bottom there, the median price of a land block in Australia in a capital city is about $218,000 today. And in regional areas, obviously, it's a little bit less. We're at about $154,000. Now, I'm going to show you some figures later that shows you what you could have bought land in Melbourne for going back just 14 years ago. It was actually possible to buy a land lot for as little as $40,000. And that's one of the things we're going to talk about today, is the power of land and how we can actually tap into that and take advantage of it. Obviously, the property industry in Victoria it's actually the largest industry in Victoria. It represents about 12% of the state's domestic product. And if we actually go further into supply and demand, what we also need to understand about supply and demand is that because of the, I guess, consumer sentiment over the last few years, and because of the GFC and because of a whole bunch of other events, consumer sentiments has generally been on the lower side, and it's been trending down. And if you actually look at this graph here, you'll see that the blue, the red, and the orange lines represent housing approvals, housing commencements, and housing completions. And you can see there that they're obviously been trending down for some time, pretty much from about 2010 when we hit the last peak of the market. If we look at the green bar, however, or the green line, that actually represents our population growth. And you can see that, again, that dipped a little bit at around 2010, but that's now on a very steady upward trend. Now, if we look at the next slide, this comes straight out of the National Housing Supply Council. And I want you to be clear on this. Australian property market is not one market. It's actually made up of millions of individual markets because every property is unique. Even a house on one side of the street could be dramatically different in value or amenity to one on the other side of the road. So it's not as easy as just saying, well, Australian property is in undersupply. There are pockets of oversupply, but as a general rule across Australia today, we are in crisis with housing. Now, if you look at the green bars here, again, the upward trend is going to be in increasing disparity between supply and demand. Now, there's a storm up in the north of Queensland at the moment, a big cyclone coming in, and unfortunately it looks like it's going to be one of the biggest cyclones we've ever faced. If you guys can remember back a few years ago, we had Cyclone Yasi and it wiped out all the bananas. Now, that actually is a classic example of supply and demand imbalance. So when Yasi came through and knocked out all the bananas, the price of bananas went up. Not a little bit, it went up dramatically. So if you could buy a banana for $2 a kilo, say today or before the Cyclone Yazi, there was a time when bananas were up at as high as $15 a kilo just because there simply was not enough supply to meet the demand. Now, I don't know about you guys, I love my fruit, I love my bananas. I didn't stop buying bananas. I wasn't real happy paying $15 a kilo, but that's the price that you have to pay when there is a supply-demand imbalance. Think about it from a property perspective. We now have a supply-demand imbalance, and that's likely to get bigger, not smaller. So again, property as an asset class moving forward, from a fundamental perspective, there is an underlying supply-demand imbalance that we can take advantage of or not. Now, if we look further down the market fundamentals, there's other things like banking regulation and how that can affect property prices. I'm not going to spend a lot of time on that, but pretty simply, the banks, the Big Four particularly, control about 90% of the mortgage market in Australia. So the banks have a very big vested interest in property prices and maintaining a stable property market. So think about this, if you're a bank and you control 90% of the property in Australia and property starts to go too fast, the prices start to heat up, we move into unsustainable levels of growth, we're hitting 15%, 20%, 30% growth. As a bank, what choice could you have to potentially slow that pace down? Well, the easiest thing you can do at a bank is make it harder for people to borrow money. And that's effectively what happens. We can control things like the loan-to-value ratios. We can control things like how hard we make it to service a loan. And effectively, we only want to give money to those people who really should have money when property prices are running out of control. The converse is also true. If property prices start to stall, the banks can actually stimulate the property cycle by making credit easier to achieve. So we might increase our loan-to-value ratio up to 95% or 97%, or if you've been around in property for a while, like Chris and I have, there was times when you could borrow effectively 105% of the value of the property, which meant you could buy the property and all your closing costs without actually having to come up with a huge deposit. Obviously, we've also been through cycles where we had interest rates at 18%, and property is cyclical. You need to understand that. If you're going to go into property, please, unless you're going in and flipping properties, property is a medium to long-term investment, okay? And the cost of entering and exiting properties is just too high to be trading on a regular basis. So if we look at other things that are happening at the moment from a market fundamental perspective, we've actually had more ducks lining up right now for property than we've ever had in the past. Foreign investment, especially Asian investment in Australian property, is at unprecedented levels. I currently work with Asian investors who are coming in and actually paying cash for properties in prime locations in Melbourne and in Sydney. So again, if you are an investor and you've got a fair amount of money behind you and you've got access to $1 million, $2 million for a property transaction, there is some evidence to suggest that buying in areas where the Chinese are coming in and buying a $1.5 million or $2 million townhouse in key areas around Melbourne and Sydney, that could be an exciting market for you to look into as well. We've also got self-managed super funds being set up en masse. Let's look at this. This is actually a game changer, people. Prior to a few years ago, self-managed super funds weren't really that popular because there was a lot of complexity in setting them up and they were hard to manage, and people just probably weren't really fussed because they couldn't leverage their money all that well anyway. But about a decade ago, self-managed super funds would have accounted for about 10% of superannuation balances. Today, that's about 30% of the nation's $1.4 trillion in savings. Now, it's a growing area without a doubt. And the biggest catalyst, in my opinion, for that growth in popularity is that people are trying to take control of their money. And in 2007, September 2007, government laws introduced allowed self-managed super funds the ability to borrow money, particularly to invest into residential property. And there is a huge number of self-managed super funds going out and buying properties, particularly in the region of $300,000 to $600,000. A lot of self-managed super funds, if they've got $100,000 or $200,000 to invest, can actually go and put a deposit on a property and borrow the remainder. Now, it's complex. There's non-recourse borrowing laws. There's bare trust that you've got to set up and all of that. So it's a specialist area. I'm not here to give you advice on that or even to tell you whether it's a good idea for you to have your own self-managed super fund, but some of you already have your self-managed super fund set up. And I am going to tell you that we have clients that are actually utilizing this land banking strategy inside their self-managed super fund because for $40,000 or $50,000, you could actually be investing in a medium to long-term strategy that could make you a whole lot more money than that. I'll run through some numbers with you shortly. We've also got things like rising costs of construction, rising costs of building, rising costs of land, and we've also got demographic trends to consider. So I want to just quickly have a look at a few things that you guys might find interesting. This is a demographic spending wave. Okay, and it makes sense if you think about it logically. When you're 18 or 19 or 20, you've either just left university or you are studying. You might have a little bit of part-time work, so you might be working at McDonald's or doing a courier job or some sort of part-time work. You don't get paid for a lot because you're actually studying. You go out and you start becoming a young adult. You move into the workforce, you get your first job or you get your first promotion and you start to earn a little bit more money. You may pair up with a partner that doubles your income overnight, hopefully, and then obviously you're going to maybe go out and buy your first property. Now, unfortunately, a lot of people make the mistake of going out and buying a mortgage. In fact, Chris, tell me a little story about what most people do when they're buying their first property.
Well, just to give you an example, I guess young people get married and they buy a house and land package in the suburbs, maybe for $500,000 or more, and then they spend the next 20 years trying to pay that mortgage off. And the reason is I guess they could have bought a house for the same price in a similar suburb, but one that had the potential to develop or subdivide the backyard and pay that mortgage out completely. So you've got option one, you spend your time paying off a 25-year mortgage, or option two, you sell your backyard in 3 years and pay your mortgage out completely. So that's the power of land, like land banking in a sense. I guess this is, the land banking strategy is what I'd really call a subdivision, for self-managed super funds and getting all those benefits. Because by the way of just putting down a small amount of money, that's just it's what we call a fairly dormant, sitting there, passive investment, and then just letting time do its thing on a 7 to 10 year delayed settlement, locking in today's price, it's not hard to imagine just how much that will grow over the next 7 to 10 years. Remembering that land triples every 7 to 10 years, whereas houses normally double every 7 to 10 years.
Thanks, Chris. So as we go back to the demographic effects and we look at the spending wave, you can see that you go out, you'll have a young family, you'll spend money on kids' clothes, education, buying the latest Xbox and bicycle or Barbie doll or whatever it is that you might be buying. And then obviously they're going off to college, they're spending a little bit more, you might buy them their first car. And then when the kids leave, everyone goes, woohoo, happy days. But what actually happens is that your spending actually generally reduces. So you might go crazy for a year or two. You might have the round-the-world holiday that you've always been dreaming of. You might buy the car that you've always wanted. But you've generally got a big 4-bedroom home or a 5-bedroom home, and there's only the two of you left, and you think, well, hang on, I actually don't need a big house like this anymore. I'm going to downsize. So you actually may go into a smaller property. Now, you may spend more money, but generally speaking, you'll probably spend less money and again put some money away for future holidays and future lifestyle. And then after you get to the age of 60 or so, you're probably not going to spend a huge amount of money. Let's face it, you've done everything you want to do pretty much, and it's time to slow down. It's time to sit on the porch and talk to the grandkids and watch them grow up. So this is really important, not only from a perspective of understanding that where our country is at from an aging perspective. Now, we're not as old as some countries. Japan is a very old country. The US is aging faster than Australia. Southern Europe is aging faster. And if you actually look at the economies of Japan and Southern Europe and even the US, they're actually in a far worse state than the Australian economy is because of some of these negative deflationary effects that occur as a population ages. Okay? Now, if we go forward and we can see here land prices to GDP, all the way back to 1911, all the way through to about 1953, land prices were actually pretty steady because we had plenty of land and we were able to just release it on a steady state basis, and it really didn't cause land to accelerate in any way, shape or form. But as our cities became more populated, as it became more costly for governments to create the infrastructure for people to live further away from the center of the cities, what you'll see is that land prices started to accelerate. And you don't have to be a rocket scientist or an economic forecaster to look at that trend from, say, the 1960s through to today to realize that that's an upward spiking trend. Here's the interesting thing about housing values. Yes, housing values have gone up, and we saw that in the last graph, but the actual cost of construction, the actual house component, really hasn't changed dramatically compared to GDP. They've been rising at about the same rate, which makes this red area or pink area look about the same. But look at the land component. Okay, look how much land is appreciating, and you've heard the saying, land goes up in value, houses go down in value. That is, houses wear out. The government even gives us benefit for that house wearing out. It's called depreciation, and it's one of the tactics that we use to help particularly high income earners to reduce legally the amount of tax that they pay while still improving their investment life cycle. So let's look at land and work out, why does land appreciate faster than house and land? And just to prove to you how much land does appreciate as opposed to house and land, let's just take an example here. We'll look at Melbourne, for example. Land, raw land or vacant land versus house and land. You can see that in the 1970s, you could have gone back and bought land for under $7,000. And I know most of you are out there in the webinar land going, oh, if only I'd bought more land in 1973. Well, the thing about that is that at $7,000 in 1973, that was still a lot of money. So it's no different to what it was back then. It's just that the numbers have gotten a bit bigger in terms of affordability. And there's a lot of indicators that actually say that housing affordability actually really hasn't changed dramatically over the years. It's always been relatively unaffordable relative to wages and to cost of living. So if we look at the next slide, we'll see that Melbourne has increased in land between, let's say, 1973 and 2006. It's increased by a multiple of 19.4 times, whereas anything with a house and land component has only increased by 14 times. Now, does that mean that house and land is a bad investment? It's only increased 14 times? No, it's a good investment. But if we could capture land only, just the land component, and we had no depreciating asset on it in terms of the building or the house, it's actually a fantastic asset to have. You can see here again, median Melbourne, median price went from July 2001 to July 2011, so over a 10-year period. That's that cycle we spoke about, the property clock, one cycle around 10 years. We can see that land has gone up in value from $71,000 in 2001 to $210,000 for an average block. But if you actually look at the area underneath that, which is called, or the column underneath called median area, we'll also see that the average block of land has gone down in size from 660 square meters down to 571 square meters. So not only has land tripled in that 10-year period, but it's actually done more than that, because the price per square meter has actually gone up even more than that, because the land has been getting smaller and smaller. And in fact, most blocks in Melbourne now are actually under 400 square meters. Okay, and that's something for you to consider for the future as well. Let's go through to the next slide, and let's talk about price-controlled stage release in new land estates. Now, Chris, you've been developing for 30 years. You've done it all, you've seen it all. Tell me a little bit about something that the punters out there who've never really thought about house and land as an investment class before, tell me, what's one of the most unique advantages that land has, particularly in the area of price control?
Okay, well, having done a 700 block subdivision before over a 5-year period, what you do is you do the project in stages to match up with the market conditions. So, for example, this project that we're talking about, it's only a small 400 block subdivision. It's very boutique as far as projects go. We'd probably do 10 stages of 40 blocks at a time when that time comes. And on the stage 1, we will walk the price up. So stage 2 would be more expensive than stage 1. And again, if the market was fairly flat, we may even just not even release stage 2 until the market conditions were more favourable. So you have complete control, and you really are just manufacturing your profits, very much like subdivision. So with that said, I look forward to hopefully helping you guys explain this more thoroughly in consultations. But for now, I'll put you back on to Matty.
Thanks, Chris. So what we're saying there is that the developers actually control the price. They can actually walk the price up and actually create what we call manufactured capital growth in these estates. Let's look at an example of an estate so you guys can get a real understanding of how this actually works in real numbers. Let's look at an example in Caroline Springs here in Melbourne, which is in the northern growth zone of Melbourne. First lot started selling there for around $40,000. That was around 2000. Now, look at what lots can now sell for in these estates. They're in excess of $350,000 for a vacant land lot in Caroline Springs today. Now, if we look at the gain there, that's about $310,000 that land prices have gone up in just 14 years. That's approximately 55% year-on-year compounding capital growth over that period of time. That's staggering, okay? And one of the reasons for it, as Chris mentioned, is that really it's probably one of the only asset classes that does not follow normal supply-demand fundamentals. So let's look at this graph here. You'll see the red line represents the price of land, and the black bars represent sales volume. That means how much activity is going on. So if we start in March 2002, the quarter of March 2002, we'll see that there was approximately 160,000 sales and that the price was down at around about just over $80,000. So as we track through for the first 6 or 8 bars there, you'll see that there's good sales activity, and we would expect the price to go up with that. You can see that after about 2003, the actual volume of sales starts to fall, but yet the land keeps going up in price. And even if we come all the way through to the GFC, which is where we see a massive drop in the volume, and we see that the red line actually pretty much stalls and just sits fairly flat, we see that land really didn't go down in value despite that supply-demand imbalance. But then obviously after a period of time, volumes start to pick up. We see land prices starting to pick up again. So land, understand this, is controlled by the developers. Usually it's large-scale developers that are doing these sorts of developments, and they've got very deep pockets. And rather than risk their profits 10 or 20 years into the future, okay, what they would rather do is sit on land and wait until the volumes pick up or until the demand picks up to allow price points to continue moving forward. In some cases, there have been examples of land estates where in really bad times, the developers still won't drop prices, but they may incentivize buyers with things like holidays, or even I've even seen developers giving away cars in order to accelerate the sales through the land process. So understand this, guys. Land has a unique advantage over nearly any other asset class, especially in property, in that the growth can actually be controlled by the development team. So what's wrong with buying land then? Sounds wonderful. Everything's great. It tends to always go up. We can control the price. What's wrong with it? Well, really simple. There's no rental income coming in from the land. Okay? So if we look at a typical example of buying a land today in any residential estate, there's a few things that I want you to consider. Number one, let's just say the land is worth $200,000. Now, for me to secure land today in a normal estate, I'm looking at usually 30 to 90-day terms, meaning I need to come up with a deposit. Let's say $40,000 in this case, which would represent an 80% LVR, which is actually high for land. Normally would be at 70% or even less of the ability to borrow. So we normally need a bigger deposit to buy just land. But just assuming $40,000 for this example. We then go out and take out a loan for $160,000, assuming that the banks will let us borrow that money. And then we're going to pay interest. Now, I've just used an interest-only calculation here at 6%. It's almost $10,000 a year that I've got to fork out, and when I include rates and maintenance, it actually takes it up, closer to $11,000 a year, which means that if I'm holding this land for a period of time, let's say 7 years or 10 years, it could actually be costing me $77,000 to $110,000 to hold on to that land. But the good news is, if I can do that, if I can afford to pay that money, I will still make money on land as a general rule based on historical growth patterns. But what if I could show you another way? What if I could show you a way where you could still hold on to all the benefit of rising land, control the land today at today's prices, but not have to take out a mortgage, have no interest payments on the land, have no additional holding costs, no rates, no body corporate, no maintenance, and we could hold it for 7 to 10 years. Now again, 7 to 10 years is a good time frame because that's typically one lap around the property cycle. And historically that property prices, house and land, will double every 7 to 10 years if you've bought in the right areas, but land could actually triple in that period of time. Now obviously it's important where we select the land. We've actually chosen one of the fastest growing areas. It's actually located inside Melbourne's now landlocked urban growth boundary. So what do I mean by landlocked urban growth boundary? Well, Matthew Guy, our planning minister in Melbourne, effectively last year made an announcement and said that Victoria has now set a boundary from which no new land will be created beyond that point. So he said that the days of the expanding urban growth boundary are over. He said that resources are now going to be poured into regional areas and Melbourne's growth suburbs as they continue to fill up over the coming decades. And he goes on to say that in 20 years from now, if you want to live in a house and land estate, that has to be outside of Melbourne. We've only got about 20 years worth of residential land in great areas for Melbourneites to actually live in. So this is going to be a genuinely fixed urban boundary, and it means that competition for land, particularly on those fringes, has to go up. Okay, that's a buying opportunity for you guys, but you need to know how to access it. The good news is we've actually put together something that I think is probably one of the smartest and most sophisticated strategies that's available in property, but we're making it available to everyday investors. All you need to have is as little as $40,000 to invest in this opportunity. I'll come back and do some numbers with you in a moment. But here we go. This is Melbourne. You can see that now where the coloured areas, the light greys and the dark greys, this is pretty much the extent to which Melbourne will ever grow to. So Melbourne's going to grow up, not grow out. So we're going to have higher density. We're going to have more units and apartments. We're going to have more subdivisions occurring to actually increase density on residential lots. And we've got a limit to how far we can actually travel. So there's 4 key areas in Melbourne. We've obviously got the Western Growth Corridor, and that'll take you all the way down to Geelong. We've got the west and northwest, which will take you into Melton and some of the other areas, Wyndham Vale, Truganina, Point Cook, those sorts of areas and beyond. We've got all the way up through the north, so Caroline Springs, which we showed you earlier, is an example of one of those growth regions through the north. And then we've got the southeast growth corridor. And in our opinion, the southeast growth corridor represents the best buying opportunities for a number of reasons. Number one, if we actually look at the current population in the southern corridor, it's actually the highest at 1.16 million. And it has the highest estimated growth of between 500,000 and 700,000 people coming into this area in the near future. If you actually look at the population and employment graph on the left there, again, you don't need to be a leading economist to predict the trend there. It's on a gentle average incline all the way up, and that's what we want with property. We want general steady state growth rather than big spikes and then big troughs. This is a beautiful pattern that I see, and it really fills me with a lot of confidence in this strategy. So here we go again, the numbers. Southern region, it encompasses the municipalities of Bayside, Cardinia, Casey. Casey is one of the fastest growing areas in Australia today. Obviously Frankston, Glen Eira, Greater Dandenong, Kingston, and the beautiful Mornington Peninsula. Some important future initiatives that are going on down here. I'm going to get Chris to explain a little bit about some of the things that are happening down through the southeastern corridor in a bit more detail, particularly the Port of Hastings upgrade, and also another potential for a third airport in Melbourne.
Yeah, look, just getting to the basic fundamentals again, the economic drivers for capital growth. Essential to this is population growth, both organic and also migration. Organic means that people are moving to that area, they're getting married and they're having children and they're staying in that area, they're getting educated, there's jobs there. The second thing is that you want jobs in every sector of our economy. For example, very dangerous to be investing in the Gold Coast and holiday apartments, which only have one industry, and that's tourism. Whereas here in Melbourne, we're so fortunate to have jobs in every sector of the economy. So that's critical. And then it comes down to just the availability of the land. So Melbourne is now landlocked, so we've got a lot of, all the ranges, they're too expensive, they can never be developed for bushfire reasons, all sorts of things. So there's a really limited amount of land. So, you know, a massive amount of this percentage of this population growth will have to go into these growth corridors, particularly the Bayside growth corridor, because the infrastructure and the beauty and just the livability of that is much greater than the northern or western corridors. So just jumping back, or just a little bit about the land banking again, it's a great thing because you're just putting down a little bit of money. You don't have to go and get a loan from the bank for 7 to 10 years. That in itself is a blessing. We all know how much we love to deal with the banks. For all those bank managers out there, I apologise. So where was I going with that, Matthew? Yeah, so infrastructure. So you know, we look at what's happening in that area, what's going to be the big news. So Melbourne's looking at getting a second port, and that's at Hastings, which is close to this growth corridor and will generate lots and lots of jobs. There was a talk of a second port going out there in the Geelong area, but it's been decided that it's just too expensive to dredge. So shortly they will formally announce the Hastings port. It's all over the media and news today anyway, if you've been reading it. But it looks as though it'll go ahead because it's going to be a lot better alternative. And that in turn will probably cause for the third airport to go into this Bayside area as well. So with all this activity, you can expect some happy days for land investors.
That's right. So the Port of Hastings, it's a $1.6 billion infrastructure project, and if you look at the map here, you'll see Melbourne calls it the economic triangle, and that's from Geelong over to the Port of Hastings and up to the Port of Melbourne. Now, Victoria has made the bold claim that it is going to be the freight state. And in fact, a disproportionate amount of freight currently comes through Melbourne from all over the world before it gets redistributed to other parts of Australia. And Victoria is committed to becoming the freight state. The Port of Hastings, I actually believe, based on the news reports today, which basically says that the plans that they had for Geelong will probably have to be shelved for both environmental reasons and for cost reasons for dredging that part of the harbour. The Port of Hastings is actually probably going to be expanded even beyond the $1.6 billion that's already been committed to. And again, that in turn will put in upward pressure on the third airport being delivered at some point in the not too distant future. So here we go. We're going to get into what land banking is and what this opportunity actually represents for you guys today. We're going to give you the exclusive opportunity to register your interest to invest in one of the fastest capital growth areas in all of Australia. We call it instant equity land banking because it's like we're actually making money on the way in. You're actually locking in profits today, even though you're only putting a fraction of the money down and not settling for some 7 to 10 years. This is an amazing opportunity. So this is what happens when we create an estate. So I just want to quickly run through this. How is an estate actually created? Well, at some point it's all farmland. Okay? Someone comes along, a developer with a vision, and says, let's make this more usable. Let's increase the density. Let's make it more valuable for people to live in this area. So they develop plans and they run those plans out and they create what we call master plan communities or living estates. Okay, obviously this one here, there's an example of some water, some open parkland that's good transport in and out of it, and they're important. Who's currently doing land banking? Well, really, these are the big players. Okay, we've got Vic Urban, Australand, Burbank, Simmons, Mirvac, Metricon, Pete. These are all the big names that are currently doing this. So there's big companies that go out and buy or secure land on the fringe of growth areas and wait until the urban sprawl or the demand for that area picks up, and they make an absolute killing. They could buy this land literally for pennies on the dollar, and they could be selling it for hundreds of millions of dollars in the future when they go through the process of rezoning and creating these estates. So this is where the real money in property is actually made. It's not in housing. So even Burbank or Metricon, you might think of them as housing specialists. They're not. They put the house on it because, yes, they can make some money on houses, but the real money, the real killing in property is actually made on the land subdivision, changing the use from rural to residential, high-density living. So how much does it cost to create a block of land in Victoria today? Well, Chris, I'll throw this over to you. You're a developer. What's it going to cost me today if I wanted to go out and do some of this greenfield rezoning residential land, not even including the price of the land? How much is it going to cost me today to develop a block, and how does that get worked out? Where's all the costs go?
Yeah, well, look, in most cases you're looking at about $70,000 plus, and a lot of this goes in council fees, in the civil works, building the roads, putting in the sewage, putting in the water, the underground power, all the services. So then you create a block of land, but then you've also got your land component on top of that. That takes quite a long time to get it from, the right zoning and get the permits to do the subdivision. But look, just going back to basics, residential land is so important. It's this simple, guys. I mean, at the end of the day, you've got your basics for survival as a human being. You need shelter, you need food, you need clothing. But I believe shelter is the most important, or land is, because you can build your shelter on that block of land. If you need food, you can grow food on your block of land. and you don't really need clothes. You can walk around the house naked. So really and truly, land is by far the most important of the three basic human requirements. We can go back to the caveman days. The guys, their cave was the most important thing, was their piece of land. And that's so true today. So having said that, yeah, look, we go through a lot of effort to make sure that we do get some really good projects with massive upside potential. And again, going through the whole council process, I think you've got another slide here, Matthew, which just shows later on. Okay, we'll go through a slide which just shows you the process, where this project's at, and why it takes 7 years to get to, delivered to the public.
Thanks, Chris, and I won't be coming over to his place soon if he's walking around the house naked. But let's get into the nitty-gritty now. Let's get to the nuts and bolts of this particular opportunity and how it's structured. Because really, when we're talking about advanced investors versus average buyers, if you remember, an average buyer wants to buy the property, an advanced investor wants to control the property, and they want to do it with the least amount of money down. So how do we control this in principle? Well, we use a thing called option contracts. Now, some of you out there may be trading options on the share market, and it's very similar in terms of the opportunity that we have here in terms of what an option contract is with property. So literally, an option contract is a legally binding agreement that gives you the right, but not the obligation to buy, we call that a call option, or sell for a put option, a block of land or a property at a specified price, we call that the strike price, during a specified price period of time. So let's make that a little bit easier and take out some of the legal things. Basically what we're giving you is for a very small deposit, which we call an option premium, we're going to give you in the future the opportunity to set a price today for a block of land, and then in the future you have the choice as to whether or not you want to enter into a contract of sale and go on and settle that block or not. Okay, now let's just click through here. Obviously, some people who've never done options before go, how does that work? What happens if in the future the block of land's gone up so much in value that the developer just wants to keep it? Can they take it back off me? Well, no. The option is a legally binding instrument, and it actually binds the seller to the strike price or to the price that we set today, so that in the future, if our price is, let's say, $200,000 and the block of land is worth $350,000 or $400,000 or even $600,000 in the future, the developer cannot charge you any more than $200,000, which is our option, or which is our contract price or strike price that we've agreed on today. Now, that's pretty cool. So let's talk about what sort of numbers we're dealing with here in terms of pricing. So we said earlier that an average block in Melbourne today is about $214,000. Now we can actually show you how you can buy a block today for as little as $127,400 through to $230,400 in today's dollars. But we're not settling on that, people, for up to 7 years or more. Now the block sizes obviously range from 213 all the way through to 402 square metres, and these are blocks in what we call an amenity-rich estate. So when we're going into a house and land estate, there's a few things that really drive capital growth in these estates, and one is the desirability for residents to live there. So in these estates we've included things like parks, waterways, cafes, access to medical facilities. It's going to be in a region which is going to be rich with hospitals, infrastructure, transport, fantastic places to live, beaches, not far from where we're at, the ranges not far from where we're at, lots of things to do, a really great place to live. And here's the kicker, guys, it's a delayed settlement of up to 7 years or more. So let's look at here we go. This is what it takes. Why 7 to 10 years? It's really simple. When we've got new land, we need to go through what we call strategic planning for a new area, and we call it a precinct structural plan. That's actually in works at the moment. So these growth corridors, these urban growth boundaries, are being designed as we speak by state governments and by local councils to provide an area where locals are going to want to live in the future and where there's enough amenities to support those people. The Plan 2050 people, the actual guidelines for Melbourne in the future, are actually designing what they call 20-minute cities. And that is that everything that you could possibly need to live will be within 20 minutes of where you actually reside. That means you've got access to, parks and gyms and schools and swimming pools and hospitals and medical facilities and all of those sorts of things. So here's the process, 7 to 10 years. We need to get the planning done. We then need to acquire the land. We then need to convert the land into developable land, and you'll see that this so far is the bulk of what we're looking at. So that's 2 to 3 years, 1 to 2 years, 2 years. We're already 5, 6, 7 years into the track. The actual process of constructing the lots, that is building the roads, building the sewer and the connections and everything else, is really, really important. The lot construction takes about a year, and then we move into obviously marketing and selling the properties, and then ultimately the housing construction takes about 9 to 12 months at the end of it all. Now that's a 7 to 10 year process. What's really interesting about this land as well is not only where the land is, but I guess who else is buying land in that area. Now Chris, why don't you tell us, who, in the area where we've selected our land banking strategy, who are some of the other big players, the big names that we're buying land right next to?
Well, this land is completely surrounded by Walker Corp, who are one of the biggest land developers in Victoria, which means that we're really going along for the ride with them. And obviously, if they're buying up all the land and land banking it there, and they've made billions of dollars out of this strategy, it's not hard to work out, you know, how much money you can make by optioning up this land. And look, you know, I was taught by people like Bernie Lewis of Lewis Land Corporation. He taught me, Chris, if you can option things, just option up everything you possibly can. And he was right, and I've made a lot of money from optioning land over the years while I'm waiting for development approvals to come through. So look forward to sharing this very valuable strategy with you.
Thanks, Chris. And again, that's modeling, people. That's learning from somebody who's getting a result that you want and just doing what they do. And that's all we're doing here, is we're giving you access to a strategy that the big players in property have been doing for a long time and making billions of dollars along the way. So here we go, people. This is what it looks like. And I want to just bring up a point here. If you're going to be an average buyer and go out and just land bank land yourself, you have to do it the normal way. That is, you're going to need to go out and buy the land. You need to settle on the land in 30 to 90 days. You start paying interest. Again, it's somewhere between $70,000 and $110,000 just in interest-only payments over that period of time. But what if I could show you how you could actually control the same result, meaning the land's going to go up in value no matter how much money you put into the deal. So you can either put in a deposit and pay interest for 7 years, or if you could control it today with an option fee of just $49,600, the land is still going to go up at the same rate regardless of how you control the property, whether you own it or whether you take out an option over it. Now, all we need to reserve your block is $1,000. The balance of $48,600 is payable within 7 days, and we've got a delayed settlement of up to 7 years. So this is what it looks like. This is the actual process. This is the nuts and bolts you guys need to understand. I'm going to take an example here of land growing at only 7% per annum. Now, if you followed everything we've already spoken about, you'll realize that that's a fairly conservative estimate, in my opinion, for what this land could actually do. So if we actually look at the land being controlled worth $200,000 today, and we look at 7% growth, we realize that over 7 years, we've actually created $121,000 worth of growth, which we control for that option premium of just $49,600. So it looks like this. Today, we secure our land in the future. We're not going to pay $200,000 today. We're going to secure the contract price of $200,000. We're going to put down an option fee, and we're going to watch the land grow in value. And that's all we have to do. There's no holding costs. There's no rates. There's nothing for you to do. It's a very passive, long-term strategy. And eventually in 2020, we would expect that land to be worth at least $321,000. Means that we've got a profit potential of $121,000, 156, and I won't worry about the 29 cents for the purposes of this exercise. So how did we get that $121,000? What did we have to put in today? Well, the money that we have to put down today is literally just $49,600. That's our option fee. That controls the land for the next 7 to 10 years, and it allows you in the future to buy that land for just $200,000, even if it's worth $321,000 or more. Okay, do you guys get the power of options and the power of controlling land as opposed to buying land? Okay, the result's the same. The land's going to be worth what it's going to be worth in 7 to 10 years, no matter how I control the property. So this is where, again, average investors worry about the return on asset. They worry about the 7% growth of that land. I want to talk about the return on investment. And that is, well, if I've only put 49,600 into this deal and the land increases at only 7%, that's the return on asset growing at 7%. My return on investment is actually a lot higher than that. Some people would love to get a free land block. I'm going to show you how you could effectively create a free land block for yourself, and that is securing not one block today, but actually securing 3 blocks of land, each worth $200,000 in today's dollars, and we're not going to settle on them for 7 years. Each block increases by $121,000. That means that if in 7 years' time I sold 2 of those land blocks down, making a profit of $121,000 per block, that actually gives me a profit of $242,000. Now, if you remember, I only need to pay $200,000 for that last land block to the developer. So let's do that. Let's pay off the remaining block, and I've still got $42,000 less fees in my back pocket. Can everyone see the power of that strategy? And for those of you who've got, 150,000 odd sitting in a self-managed super fund or in cash or equity, this is a strategy that you really may want to consider for that long-term growth. Okay, so who can benefit from this amazing investment opportunity? All sorts of people. Obviously, those that are already investing in property with the basic buy and hold strategy. Okay, this is a buy and hold strategy. It just means I'm going to use less money, I'm going to have less holding costs, and I'm going to control the land for a lot longer before I'm actually needing to actually pay any further money into the strategy. Credit impaired investors. I know that there's maybe some self-employed people on the call today. There might be those that are either too young or too old to get normal bank finance. This is a strategy where if you've got the cash, so let's say you're a self-employed plumber, you've got good cash reserves, but you've only been doing it for a year, you can't actually qualify for normal bank financing, but you want to get into the property market today and you want to take advantage of that future growth. This is something that you could do. Parents with children. Now, Chris, tell me, who can access this as a parent? What can they do?
Well, as you know, property prices are really getting out of reach for most people in Melbourne and Sydney, and we are seeing parents actually now buying properties for children as young as 5 years old. What this means is that I guess the parents could be securing these property options for their children, so that when they does come time when they want to get their own house and move in and start a family, that they'll be in a position to do that. So it's very important to think forwards to the future, what's going to happen with your children and how you're going to set them up for the future. For retired people, a great way to get in there and just put down some of that money. Perhaps you've got some super money and you can grow that super money so you'll have something there again. Particularly when most people are living through to 85, a lot of people haven't planned on that. I guess a lot of people think that somehow magically money will appear. The other one we're looking at is, I just wanted to mention too, the average price of a block, like we showed you before in Caroline Springs, they're around the $400,000 mark, and really I think we're looking at about an average of $300K for just a vacant block of land in the western suburbs of Melbourne. So to be getting it at these prices, which I think are around the 120 to 160 mark, is extremely good value. Now, just put Matty on. We are going to put in a consultation, so we've got a special offer which Matthew's going to walk you through. So I'll just put him back on for that.
Thanks, Chris, and we really appreciate all your wealth of knowledge. And again, you guys out there on the webinar are going to have access to both Chris, myself, and we've got 3 other senior property consultants that we've put some time aside over the next week to help you get access to this amazing deal. Now, in the estate itself, there's about 360 land blocks. We've now got less than 280 of these left, and this is actually our pre-launch. This is our first webinar, so you guys are actually getting in ahead of a lot of our database. We actually haven't advertised or marketed this in any way, shape, or form. It's just been our existing members who've had first pick at this to this point in time. Now, a consultation is what I would suggest most of you are going to want. You're going to have questions. Is it right for you? How do you get access to it? What are the time frames and all of that? We're going to help you to walk you through that in a moment. But before I do that, I want to give you something very special. Where do we go from here? Well, today we've covered a fair bit of ground. We've shown you the difference between how our 21st Century Property members buy property and how average buyers go out and do it. I think you'll both all agree that there is a big difference. We've looked at what is driving property, both the short-term and the long-term influences, those sentimental and fundamental differences. We've looked at the supply-demand imbalance. We know that property in an imbalanced state at the moment. And even if we built properties at the fastest rate we've ever built them, we probably still don't have enough properties to provide for the growing population that we have here in Melbourne. We spoke about why land is such an attractive option, but in the past how it's been so difficult for people to access just land because of the high holding costs. Most people don't have a spare $100,000 over 7 to 10 years to throw at land and not get any income coming in. We looked at how to actually choose an area which is going to, in our opinion, have the strongest fundamental reasons for growth. That's why we've chosen Southeast Growth Corridor, the Bayside area of Melbourne, highest population, highest potential population, and probably the nicest place in Melbourne to live. We've given you some examples of a 7% return. There's always risk in anything that you do. One of the biggest risks is not even being aware of what this opportunity is. And that's what this consultation will help you to do. We'll talk about the return and the reward. And I'm going to show you now how you can actually claim a $10,000 gift for those that are wanting to take action and actually secure one of these blocks for themselves. Jamie McIntyre, 21st Century Education, 21st Century Property have actually given you a $10,000 first landowners grant that you can actually apply towards your option premium to get this moving forward faster for you. So remember I said that option premiums are $49,600. Well, taking advantage of our $10,000 free gift, you can actually secure an option today for as little as $39,600. Same rules, $1,000 reservation, but the balance now becomes just $38,600. Everything else is the same. We're in a growth area. We've got delayed settlement. We've got low cost of land in today's dollars relative to other blocks that are out there. And it really is an opportunity for you guys to strike while the iron is hot. Okay, and it does not have to be 7 days necessarily. Some of you may need to get, refinance done, but ideally, the faster you can do this, the better the blocks that you're actually going to be getting from this. Option premiums, $39,600. Interest savings alone could be worth $70,000 over the course of this investment. Profits on the block, even at just 7% growth of the blocks, is an additional $121,000. So if we take away your option fee, add back in the savings from the interest and the maintenance, add the profit on the block at a fairly conservative 7%, you could literally make $151,000 per block for a $39,600 investment. Now, people, if you can't see the value in that, then don't call us up because this is not for you. But here's how we go. Here's how we go to get you access to that. We need you to book a priority consultation to claim your $10,000 grant. Okay, they're not going to just come and be delivered to you. You need to book and call to get access to that $10,000 grant. I'm going to put up here on the screen now Chris's email address, direct email, cfreeman@21st Century Academy or 21stca.com.au, and my email, mbateman@21stca.com.au. I'm going to leave that up for a moment. Okay, and what I want to do is I'm starting to get a few questions filter through here. There's obviously, on a large call like this, I've actually got hundreds of you out there. What I need to do is probably defer the questions to an individual one-on-one question and answer session with either Chris, myself, or one of the other 3 senior consultants at 21st Century Property. We've gone a little bit over time today. I appreciate your patience for everyone who stayed on this call. I hope you've got massive value out of this today. I'm sure that when you actually have the opportunity to speak with Chris or myself or one of the other senior consultants, we're going to add even more value to you and determine whether or not this is a great strategy. Between now and then, if you've got any questions, I see a few coming through, can you just email them to either Chris or myself? We'll absolutely get every single question out there answered for you. Ultimately, some of you are going to be having high-level questions needing answered. Some of you just need to go, well, I haven't quite got $39,600 at the moment. What can I do? Again, those consultations will be paramount in helping us to determine, A, is this the strategy for you? And are you the strategy, or is this something that you can take advantage of now? Perhaps it's another strategy that's actually better for you. So again, this is powerful. This is medium to long term. Some of you need faster work. Some of you need short-term money. That could be our subdivision or our development strategies. Some of you want buy and hold strategies. We've got those available for you as well. Again, becoming a property member enables you to have access to not only all of the unique deals that we do for our members, exclusive off-market transactions direct from developers to our members, but it gives you access to our team of professionals, our Rolodex of allied mortgage brokers, accountants, finance specialists, solicitors, conveyancers. We'll give you access to the best of the best. So your membership also entitles you to have a mentor for the life of your membership. We'll tell you all about this when you call us or email us in. So I'm about to sign off, guys. Hopefully you've written down these email addresses if you want questions answered quickly. But for all of the rest of you, we will be in contact with you to give you access to a direct consultation where you can claim your free $10,000 landowners grant direct from 21st Century. We can go through and make sure that if this is something that you can access today and want to access today, that we can allow you to get access to it. And I'll tell you this, there's a limited number of blocks. Not all blocks are created equal. Okay, so when you get online, if you're thinking, umming and ahhing about this, get online quickly. Find out if you qualify. Is this right for you? Because if it is, you'll get access to you get to cherry pick the best blocks. Chris and I have actually already gone through the estate and we've cherry picked some of the best blocks. North facing where possible, corner blocks, park views, water views. So make sure you get in early if this is something that even interests you, even a small degree, because the earlier you get in, the better your result's going to be. The early bird always catches the worm with us. We reward action takers. We're giving you $10,000 straight away. Get online, send us an email. I appreciate your time. Great speaking with you today, and I look forward to speaking to you again real soon.